everyone. I'm Rafaela Brunetti, and I'm the Managing Director for the CAFE program. And on behalf of DOC, we'd like to welcome you all here for CAFE's final presentation. This semester is extremely important because it marks 20 years of the CAFE running money. And I just wanted to wish a huge congratulations to DOC and all of his success over the past 20 years. So congratulations to you, DOC. And I would also like to give a huge shout out to this awesome group of student fund managers that I had the opportunity of working with this semester. They put in an amazing amount of hours, and I give them so much credit for it. And I'm extremely excited for you to see all of the hard work they put in this semester. So without further ado, here is the Fall Student Fund Managers.
Hi everyone, I'm Kelsey Mangan.
I'm Brett Wagner.
And I'm Dom DeFeo. We are the Healthcare, Industrials, Energy, and Staples Analysts.
I'm Zach Zanzalari.
Sims Royce.
And I'm Jimmy Keene. We're the Financials, Consumer Discretionary, and Basic Materials Analysts.
I'm Johnny Doherty.
I'm Max Kimmel. And I'm Sam Petrocchi. We're the Technology, Communications, Real Estate, and Utilities Analysts. Moving into the MD role next semester, I'm truly honored to carry this program into the future. I want to give a special thanks to Raf, to Professor Mackey, to Doc, and to all of our esteemed alumni for allowing us this opportunity to be at the highest level of student portfolio management. Now I'm going to hand it off to our student fund managers to tell you what exactly it is that we do in the CAFE and how we distinguish ourselves.
So I'm sure you're all wondering what exactly we do in the CAFE. We manage 2 real dollar portfolios totaling over $500K in equities. These portfolios have 2 different objectives. We have a CAFE Growth Fund and a Gabelli Value Fund. The unique opportunity CAFE offers us to take different roles acting as portfolio managers, analysts, and traders.
As portfolio managers, we have a multitude of responsibilities to ensure we are efficiently managing money. For example, we must follow our designated weighting scheme, as shown above, and additionally, we discuss our weekly PM reports which monitor the performance of our respective sectors, any economic indicators, and any areas of concern after reviewing news.
As analysts, we are responsible for producing 4 daily reports where we're looking at the intraday performance of our holdings, global market movements, as well as global news. At the beginning of the semester, we are each assigned sectors where we look at our individual holdings within these respective sectors and determine how they are reacting to the market.
Within these sector pairings, we conduct earnings analyses and we build pitches for potential holdings for our funds. This allows us to evaluate our funds' holdings on a day-by-day basis and determine that they all fulfill our fundamental requirements. Next, we have the opportunity to be traders in the CAFE. The CAFE is the only portfolio management program in the country where we actually get to execute our own trades as students. In tandem, we're the only school in the country that offers technical analysis thanks to DOC at the undergraduate level.
As traders, we're able to use tools such as Quote, which is pictured on the left and in the top right here, as well as Bloomberg in the bottom right, to find optimal buying times when buying and selling these companies.
Now getting into our methodology and how we actually invest, we take an active management approach to investing, allowing us to quickly adapt to changing market conditions.
This is in contrast with a passive buy and hold approach, and in the CAFE, we can completely readjust our funds at a moment's notice.
We do this in a lot of ways, whether it's analyzing economic news at table meetings. We also have a buy list ready to quickly sweep any companies that we deem need to be sold.
As we've mentioned, we utilize what is called a top-down analysis. What this does is allows us to understand what it is that's driving the market. So we look at this with an economic outlook and lay that as the foundation for the market. From there, we're able to identify which sectors should be performing well, then on to which industries we think will perform well, and then finally getting to the companies.
And we choose these industries and companies using an integrated approach, which encompasses fundamental, behavioral, and technical analysis.
Through fundamental analysis, we're looking to identify key financial ratios which we like to see increasing at an increasing rate.
Like Max was saying, fundamental analysis is pretty cool. However, it doesn't tell you the full story. It is the buying and selling behavior of investors that determines which way a stock price will move.
This is called behavioral analysis. Through behavioral analysis, we can see how investors view a company through news. Sometimes this can actually drive a stock's price more than fundamental performance or the operations of a company. This provides us the opportunity in the CAFE to buy in at a price that we believe is suppressed due to overreactions in news.
Finally, through technical analysis, we're able to time our intraday trades, allowing us to capitalize on gains, ultimately letting us buy low and sell high by measuring changes in sentiment and momentum.
As a fund using a top-down approach, it's important that we outline our economic outlook. We do this by analyzing indicators such as unemployment, inflation, GDP, and consumer sentiment. With 2024 being a high interest rate environment, we expected these indicators to show a contractionary period.
Now, in the job market, we saw the unemployment rate increase by 7.89%. Now, as Q mentioned, this is a high inflationary environment, so it's typical that companies are willing to spend less, leading to hiring freezes and layoffs. As we can see in the consumer price index over the same time frame, inflation has started to cool, but remaining to move linear, moving towards the Fed's 2% target.
And the decreased business spending also caused GDP to decrease this year by 15.63%, along with lower consumer spending compared to 2023. You may notice that consumer sentiment is going up. However, reading at 70, it's still far lower than its historical average at 85, meaning we're 15% more pessimistic this year than we normally are.
Now, it's always an interesting time when the Fed cuts rates. We're able to use this year's landscape and compare it to landscapes of years past. As you can see on the chart, 11 out of the past 15 times the Fed cut rates, a recession soon followed. Unemployment, GDP, and consumer savings rates all followed this recessionary trend.
We also saw other tools showing a recession coming early in 2025, including the inverted yield curve. Each of the last 3 recessions followed the correction of this yield curve, which just corrected this quarter in our current cycle. The SOM recession indicator, which measures the 3-month moving average of unemployment, anytime this average rises above 50 basis points in a reading, a recession has followed, which also just happened in August this year.
So where's the recession? I mean, Q just told us it's time to panic, but as we can see, the market is reaching all-time highs. Well, that seems to be the case for every month besides July of this summer.
Now, I can speak for the summer analysts in saying being in a cafe during this time was very scary. But this was caused due to U.S. institutional investors in Japanese markets through carry trades. However, we saw a recovery that was surprising, and the market continued its upward trend.
As we approach rate cuts in Q4, we were uncertain how the market was going to react because of what happened this summer.
We also had to consider the fact that this year was an election year, so we had to consider the effect of how either candidate winning would have on markets, in addition to the policies that they'd implement and how it could affect our current holdings.
Fears were high during this period of uncertainty, but through it all, the market pushed through and continued on its course to record highs.
Now, given everything we're telling you, there were a number of challenges with our traditional investment approach this semester. Namely, the fact that the economy and the market were showing us 2 different environments.
We truly weren't in a good spot. I mean, interest rates were high, there were conflicts worldwide, and prices were up. Hell, a Starbucks coffee was $7. That's ridiculous.
I mean, this is obscene. If you were to tell me at the start of the semester that the S&P would have ran straight through 6,000, I would have called you crazy. However, the market has returned approximately 27%, which is even crazier, considering that on average, it has returned around 10%.
And all of this caused us to change our investment approach. Instead of using the traditional top-down method, which Dom outlined earlier, we were able to adopt a modified bottom-up approach where we evaluated a company in tandem with the overall economic climate.
Here's a perfect example of an event that happened that caused us to change our investment approach from top-down to bottom-up. We're talking about the port strikes. These were happening all the way from the northern tip of Maine down to Texas, which is pretty crazy. Jimmy here is going to tell you what we saw.
Now, the key word here is East Coast port strikes. This is exactly why we looked at a company like Union Pacific Corporation. They're a railroad company, and not only is the railway industry steady, look at this map. I mean, they do not touch the East Coast at all. This is exactly what we were looking for. We wanted to mitigate any risk against further port strikes.
One of the most important aspects of a bottom-up approach is diving deeply into the company's financial statements, most importantly, this being the statement of cash flows. With this, we're looking for positive trends in both dividends, as this can depict financial stability within a company, and free cash flows, and Jimmy's going to tell you why it's important for industrials.
Yeah, it's important for industrials is that we look for capital expenditures, so these companies reinvest back into their business to continue growth. Now, as you can see with Union Pacific, they've been doing this for the past 5 years. Specifically in 2023, they invested $3.7 billion back into their business, leading to nearly 400 miles of railway. This paired with their increased free cash flows is very favorable for the future.
Thank you, Jimmy. Now, anyone that's analyzed the markets this year has heard about the Magnificent Seven. As we turned our attention to these companies in the cafe, we related it back to a market concept called bad breath. Bad breath in the market is when a few select sectors or companies are propping up performance rather than equal performance from the whole.
I'm sure as many of you know, the Mag 7 companies are Apple, Amazon, Alphabet, Meta, Microsoft, NVIDIA, and Tesla. These 7 companies alone can be seen to make up 31.93% of the market.
And given that 30% of the market, as you can see on the chart, has ran over 60% this year, we can assume that 18% of the S&P 500 gains can be attributed to just these 7 companies, and the other 493 have accounted for only around 9%.
And as you just heard Q mention, it's crazy to think that 7 companies alone have been able to outpace the market by 30%. We've seen this be able to happen due to the inclusion of different buzzwords such as artificial intelligence and weight loss drugs, in addition to external events such as war premiums and the influx of foreign investment.
Certain words can impact the Mag 7, which overall drives the market, but it's key to ask yourself, what would happen to these overvalued companies if the Mag 7 were to pop?
And the overvaluation of the Mag 7 is translated to the market. As you can see on the chart to the right, a market PE ratio over 22 is considered overheated, and this year the market went all the way to 27.37, well into its red range.
Johnny,
Talk to me, Sam.
if we're being brutally honest here, I think anyone in the crowd could tell us that the market has been hot this year and that technology has been a strong performer. However, 2 sectors that stood out in particular were financials and utilities.
Our main competition in gold each day is to outperform the S&P 500. Right now, the S&P is on pace to record around 27%, and that's the target that we strive to beat.
Now please direct your attention to the bottom left corner where we have a style box. Typically in a bull market, you'd expect small cap growth stocks to lead. However, this has not been the case, and large core and large growth stocks have really taken off.
You can take this all back to our talks about the Mag 7 and how their impact is driving the market.
Here we have Stovall sector rotation, and what it allows us to do is see how sectors rotate through an average economic cycle. By tracking the year-to-date returns, we can see exactly where we are in this rotation.
As we can see on the screen here, we have more defensive sectors leading the market this year, which has made it difficult to analyze because, as this would indicate typically, is that would be in a contractionary period, but knowing how much the market has run, this is not true. This has made this tool very difficult for us to use, as it is contradictory due to this year being an anomaly.
And you might be confused. I mean, this is a little weird. On the contraction side, you have utilities running 30%, and on the expansion side, you have industrials running nearly 26%. If you look at information technology, these 2 defensive sectors are strongly outperforming.
Now we'd like to showcase our CAFE Growth Fund. Given the strong and consistent returns of the market this year, we elected to be moderately bullish until year's end.
As you've heard, in growth, we look for short-term drivers that we believe are going to lead these companies to see strong gains over a short-term horizon.
We like to say we invest in the stock and not the company to pick up on these short-term drivers, all based on current market trends.
Thank you, Johnny. Let's get into some of the catalysts that we look for in our growth companies.
One of the most important catalysts for growth is G prime, or better known as the earnings growth rate. In the example on screen here, we're looking at one of our technology holdings, F5 company, and you can see that there's a difference between their trailing PE ratio and their forward PE ratio, which has given them a growth rate of 44.65%. With this value, we are often looking to make sure that it is not too high, as this would raise questions about sustainability of growth within the company, but a value that's too low makes us question whether or not the company is even growing at all.
Now let's talk about one of my favorite drivers. If you take a look at the chart here, we have United Therapeutics' free cash flow statement, and you can see that their free cash flows are actually increasing at an increasing rate. This is a driver that we love to see in a growth company because it shows us that the company is earning more than they are spending, and they are able to reinvest to spark growth.
We also like to see decreases in share buybacks. Now, I know what you're thinking. Don't share buybacks lead to price increases? They do, but this also allows companies to prop their price, something we want to avoid. This is why we look at companies like Primoris, who year over year have seen strong decreases in share buybacks, while also seeing sustainable growth.
Additionally, we look at mergers and acquisition strategies of a company. This is due to growth being split into 2 categories, organic and inorganic. Inorganic growth can come from these aggressive merger and acquisition strategies, as we can see with the example on screen here, CRH, who has acquired over 10 other companies this year.
Let's talk business segments. In growth, we look for favorable business segments that expose us to cyclical returns due to our shorter-term outlook. Here we have an example of Amazon, which we have held in our fund since mid-September due to their massive online stores presence going into Q4.
Now, when looking at this graph, one thing you'll notice is that we're overweight consumer discretionary. This is done intentionally. Just think about what time of the year it is. It's the holiday season. We see people going to these discretionary stores and spending their income looking to buy holiday gifts, ultimately driving these companies.
On the flip side, we chose to underweight healthcare, one of the more defensive sectors. Healthcare has been the worst performer year to date and experienced significant volatility moving into the election, which we wanted to avoid.
Now finally, I don't know about you, but when looking at this graph, one thing stands out to me. It's how heavily we're weighted in information technology. This was done intentionally though, as we're still at market weight just over 30%. And with this, we are at this weight as we look to maintain exposure to both data centers and semiconductors, as we've seen them been able to run the market this year.
Thank you, Max. If you refer to the fact sheets that we gave you, you can see our CAFE growth holdings more clearly. I just want to outline in our growth fund that we hold more mid-caps. Anyone familiar with these companies such as ACIW, Flex, Targa, and Prim at the time that we bought them were all mid-caps. Typically, these are more volatile, so we don't want to hold them in our value fund. However, if done right, it allows us to see shorter-term gains in a much sharper way. And one holding that I wanted to outline using fundamental analysis is Broadcom. Broadcom is the second largest company in the semiconductor industry behind NVIDIA, but as you can see on their fundamental chart, they're far outperforming their direct competitor and their industry as a whole.
One of the metrics I'd like to point out here is what we call EV to EBITDA. We typically look for a value here less than 10. What you need to know about this ratio is it tells us the cash flows a company is generating relative to its size. Here you can see that Broadcom is outperforming its direct competitor NVIDIA and is in line with the industry average, making them the best fundamental holding in the semiconductor industry, which has run the market in 2024.
Yeah, and the strong performance of the semiconductor industry is the only reason that we elect to hold a stock that's considered more risky. This really outlines our growth objective, capitalizing on the best stock fundamentally in a strong industry.
Yeah, so analysts at Zacks love Burlington stores, and we do too. Their competitive advantage lies in the strategic openings and relocations of stores.
Yeah, and Burlington also has this really cool approach to organic growth where their new stores can come online and generate $7 million in revenue their first year. This is special to them. Additionally, the discount stores industry has been growing in popularity because, as you know, people want name brands at discount prices given how high prices have been recently. When you pair this with the fourth quarter cyclicality of Burlington, you can see the perfect behavioral drivers for them to be a strong growth holding moving forward.
Now, Zach and Sam talked about behavioral analysis. Now it's time for technical analysis. This refers to looking at price trends over certain periods of time to identify company trends.
In the example on screen here, we are looking at one of our healthcare holdings, Boston Scientific, outlined in an upward trend channel. With this upward trend channel, we see strong lines of support and resistance that highlight the trend they've been in, and we can see this consistent trading volume throughout this time frame, which has allowed them to stay within this trend.
As you can see in that first purple box, a false break occurs. This is where the price drops below the line of support, then quickly recovering back into its upward trend. This showcases the price stability of Boston Scientific, and there's a reason why Value Line gave it a 90 out of 100.
Additionally, if you shift your attention to the second purple box here, we see what is called a moving average golden cross. With this, we see the short-term moving average line cross the long-term line from below, indicating that the company has regained its momentum and will re-enter its uptrend.
Now, due to us being actively managed portfolio, we have the unique opportunity to capitalize on market anomalies. This is seen with our holding CRH.
Now, CRH is interesting. They're actually headquartered in Dublin, Ireland. This gives us international exposure while mitigating against domestic risk.
CRH is in the building and materials sector, and they specialize in sustainable asphalt and concrete for home starts and roadways. A big revenue driver for them this year has been the U.S. Infrastructure Spending Act, as they have seen a lot of increased revenues from the U.S. Highway Administration for sustainable highways across the United States. This has in turn generated the cash flows that might be necessary to get them onto the S&P 500. And as we like to say in the cafe, we buy on rumors and sell on news.
Since our buy-in date of September 20th this year, we've been able to realize an HPY of 11.56%. Not only is this due to the stereotypical value fundamentals that this company has, but also the company's unique method of mergers and acquisitions, with 8 major M&A events this year alone.
Now, one of the best parts about the cafe is that we have the opportunity where we can make plays on earnings. The example on screen is a perfect example of this, where we're looking at Primoris Services Corporation. With this, we looked at their price movement leading up to their earnings announcement and analyzed what was happening with their previous earnings reports, the price reactions to these hits and misses, and what drivers remained present from previous reports.
With Prim, we first noticed that they had beat on 6 of their past 8 earnings reports, in addition to a strong correlation to their business model and that of the utility sector, which has performed very well year to date. This helped indicate to us that Prim would be able to beat on their earnings once again, which they did, resulting in a 14.78% price reaction, contributing to their now HPY of 38.12% in under 2 months.
Now, any analyst knows that earnings is the scariest time of the year, with volatile movements becoming regular. One of our biggest setbacks that we saw this year was in our growth technology holding, OLED. OLED makes display screens for electronics, think smartphones, laptops, and TVs. This makes them cyclical to Q4 as the demand for these products normally spikes.
Guys, we thought this was a gift. A growth trend broke out with 3 higher highs and 3 higher lows as they were going into their top historic quarter.
Yeah, we also saw price target raises and a moving average golden cross just before our buy-in date, indicating that this was going to be a steady uptrend.
Now, please, let's talk about earnings. We were confident as ever as we went into these earnings, as we did not read one article from any investor with a poor recommendation.
However, OLED missed significantly on their revenues, causing an earnings drop and a negative 13.65% HPY at the time that we sold them. This is really a lesson on how risk incurred during earnings can come back to haunt you, despite all the upward trending signals that we saw beforehand. Now, in the cafe, we have the unique opportunity to be portfolio managers, and a major portion of this is being able to reallocate and reconstruct our growth fund every single semester. And here we're presenting our fall semester growth fund statistics. As you can see, we've outperformed the S&P on a raw return basis, but as industry professionals know, this is only half of the equation, with the other half being risk or beta.
Yeah, so with our beta being lower than the S&P, it allows us our portfolio to be less volatile, additionally leading us to calculate different ratios, such as CV, or our risk to reward ratio. What this means is that for every 1 unit of reward, we take on 0.95 units of risk. Additionally, this lets us go, or 0.79 units of risk. Additionally, this lets us calculate our Sharpe and trainer ratios. The Sharpe ratios are total reward divided by total risk, or in this case, 0.71. Meanwhile, the trainer ratio shows our total reward divided by systematic risk, or beta.
And this all leads us back to our risk-adjusted return, or alpha, of 72 basis points. All this means is that if you invested with us at the start of the semester, on a risk-adjusted basis, you would have returned almost 1% over the market, which is all the more impressive considering that it was just a short 3-month time period.
Now, the cafe has given us the tremendous opportunity of being able to manage 2 different funds. With this, I'd like to introduce the Gabelli Value Fund, where we are investing on a longer time horizon and have adopted more of a moderately bearish approach compared to our bullish approach in growth.
So in value, we're looking to identify companies that we believe are trading below their fair value, and ultimately we'll be able to reach it. With the bull run that the market's been on this year, we were left with the question, is value dead?
Now, it's no secret that value investing has yielded lower returns than growth over the last 2 years. The chart here that you guys are looking at is the S&P 500 split up into a growth category in navy blue and a value category in light blue, and we can see that growth has outperformed by nearly 34%. We believe that this is due to the introduction of online brokers such as Robinhood, flooding the market with individual investors who are very reactive to news.
With the increase in ability to trade and market knowledge for the average investor, we've been left with the question, is value dead? And does it even exist?
What we are seeing is these undervalued companies correcting far faster than ever before, and this is due to the importance of these individual investors highlighting how much it means to us as we now have to incorporate more behavioral analysis than before.
So with this, we were ultimately sent on a vision quest where we were looking to see, does value still exist? And ultimately we came to the conclusion that yes, value does still exist, however it just looks completely different in its current state. In the past slides and the ones to come, you'll hear what value means to us and how we were able to approach this unique dilemma.
Now, we've already talked to you about how we're moderately bearish going into 2025 because of the economy. However, you may be asking if the market is showing a similar outlook. The chart on screen outlines the S&P 500 companies broken down by sector that have reported positive or negative guidance going into 2025.
As Sam was saying, the majority of these companies are revising negative guidance going into 2025. I mean, look at this graph. It might seem a little intimidating given to all the red on it, and you might be a little concerned. You probably should be, and I'm going to tell you why. So a lot of these companies are implementing cost-cutting strategies to weather a coming storm.
Now, I mean, come on, guys. This is absolutely ridiculous. I mean, look at consumer staples and financials. Not one company has reported positive guidance going into 2025. I mean, especially consumer staples. They're a defensive sector. They usually do well in market downtrends. Q, what's going on?
Well, with consumer staples, they usually sell inelastic products. Think Procter & Gamble, they sell paper towels and they sell toothbrushes. During 2023, when inflation is going up, they get to increase their prices because consumers will still buy. During 2024, with inflation going down, Procter & Gamble now has to revise their prices down, hurting their revenues and hurting their margins.
Now, I know this might seem depressing, but this actually allows us to be diverse and mitigate risk. And these conditions, they offer great opportunities for value investing as companies with strong infrastructure can weather any storm. This is what will really divide momentum stocks from strong value companies.
Now, we'd like to introduce what value really means to us. This semester, we had an opportunity to sit down and spend an entire lecture with Doc and talk about what value means by looking at famous tenets from investors dating all the way back to those of Benjamin Graham. With this, what we were able to construct is what we refer to as our value Bible.
The first thing we look at are strong cash outlays. That means these companies are cash rich, being able to reinvest into their business and spark growth. We all know Microsoft does this, but did you guys know that they just bought a nuclear facility to sustain power to their data centers? I mean, that's insane.
On top of this, we are looking for a strong margin of safety within these companies. Margin of safety refers to how far a company may be trading off its 52-week high and how much room remains to the upside for them. A perfect example of this is our real estate holding, Gaming and Leisure Properties, which, as we were analyzing them, we could see that they had plenty of room to the upside, and that made them a strong value holding for us.
A sometimes overlooked value driver is strong management. Can I get a show of hands? How many of you have heard the name Warren Buffett? Well, I see everyone's hands up, and that's because he's the exact type of strong management that make Berkshire Hathaway a very strong value company in our fund.
And brand recognition is key. This is what keeps consumers coming back and buying products. And in terms of McDonald's, I know when I'm driving down Medicom and I see those golden arches, all I'm thinking is that I need a Big Mac.
Next, we look for a strong performer in ignored industry. Universal Health Services, or UHS, is the perfect example of this, as they're in the medical facilities industries and hospitals are essential, providing us stability within our value fund.
Now, I don't mean to bore you guys with all these numbers. I know we've thrown a lot at you, but we also need to look at decreasing EV to EBITDA with the goal that is less than 10. Now, Comcast checks this box, but that's not the only reason why we invest, is we really believe in this company. Who here is from Mass? Now, let me run you through some of your cable providers that you could go with. It goes Comcast, Comcast, Comcast. They're the best cable provider available. Not only that, I bet you guys don't know this, they actually own Universal Studios. I mean, Harry Potter World, come on.
Next, we also look at historical market performance. In our example on screen, Philip Morris, they've been around since 1847 and are the global leader in tobacco sales, making them irreplaceable within their industry.
And most importantly, within our value fund, we need to understand what it is exactly the company is doing. I'd like to see a show of hands of how many of you guys own an iPhone? Exactly, many of you. So what this does is creates a steady revenue that we are able to understand what it is doing with these favorable products from an example like Apple.
Now, I'd like to get into our value weighting scheme. Fred, you want to take us off?
When getting into our value weightings, we decided to take a more defensive stance on markets than we did in our growth fund. This can be seen by both our overweight in communication services and financials, in addition to our at-market weight of healthcare as opposed to our underweight in the growth fund.
Now, you might be wondering why we decided to be so underweight in information technology. This is a perfect time for me to point out the difference between our growth fund and our value fund. In our growth fund, we have a moderately bullish outlook till year's end, while in value, we're moderately bearish going into 2025. And this underweight position mitigates our risk in the event of the tech bubble bursting. Similarly, we decided to be underweight in energy. This is because geopolitical tensions have caused volatility in oil prices, and that's resulted in a volatility in stock prices throughout the energy sector, and this is a risk that we wanted to eliminate in our value fund.
Once again, you can refer to the fact sheets that we passed out to you to see our value fund holdings more clearly. One holding I want to highlight is our real estate holding, as we don't hold any real estate companies in our growth fund. Our company, Gaming and Leisure Products, owns and operates casinos around the U.S., and they actually own the casino in Tiverton, Bally's. So friends, family, if any of you are thinking about gambling tonight, you'll really be helping out our value fund.
Next, we'd like to present to you our correlation matrix. Matrices are a huge part of what we do in the cafe, as in any given day, we're looking for 70% of our portfolio to be in the green and the other 30 in the red. If you look to the quote screenshot we've handed out to you, you'll see this, exactly how we talked about, and that's due to the matrix. When making a matrix, we strive for as little red correlation as possible. These correlations show that these two companies move closely together. For example, if I was to take one step forward, Jimmy would too. Or if I was to take one step back, Jimmy would also. When making a matrix, we strive for a healthy correlation of yellow and green, showing that we have a diversified portfolio.
Now, as Max said, correlations are truly key. We do this on a sector-by-sector basis, and as you can see in the mini matrix above, this is our healthcare sector with a healthy amount of yellow and green. By doing this on a sector-by-sector basis, lets us build a truly diversified portfolio.
Now, I would like to draw your attention to the main matrix, the mini matrix, and the sheet on the right. And one thing you'll notice is that we incorporate the SPY. By incorporating the SPY, we're able to see how each one of our individual holdings is moving in correlation to the broader market.
Now, we'd like to introduce one of our value holdings from a fundamental perspective. On the screen here, you're looking at Zimmer Biomet compared to the industry leader, Abbott Laboratory. On the screen, we have highlighted the most important fundamentals we deem for our value fund. And as Jimmy mentioned earlier, one of these is EV to EBITDA, which Zimmer has a very strong value in. Additionally, we often look at the margins of the company, which is why we've chosen to highlight the gross margin due to how well it is compared to Abbott Laboratories.
Zimmer offers their products in over 100 countries, including prosthetics, dental implants, digital technologies, and surgical tools. This, paired with an aging population, are key to Zimmer's success. Going off of that, Zimmer also has increased earnings, which translates into their high ratings for earnings predictability, financial strength, and price stability.
Now, I'd like to direct your attention to where it says price target and what you can see there. This is a cool tool that we've created this semester that looks at the price to cash flows, price to earnings, price to book, and price to sales of a company and creates a target price. What it's doing is using a weighted average trend of these values that I mentioned to create this weighted average target price, which you can see with Zimmer was 153 when we pitched the company, but the company was only trading at $110, giving us 38% to the upside and making them a true value holding.
Moving into the election, we wanted to avoid any volatility around the healthcare sector, which mainly was seen in the drug manufacturers and the insurance plans industry, which led us to Zimmer, which is in medical devices. Going off of this, it's a success, as in the top right corner, we outperformed the healthcare sector by over 4%.
Now, I would like to introduce you to our holding Disney. Disney is the value company. Not only is it a blue chip company, but it's also a titan of industry. And as we all know, the mouse has been running the silver screen since the 1920s.
A company like this can truly do it all. From the 12 theme parks they own, their cruise lines, and the movies that we all know and love, they just don't stop. They also own ESPN. There are 7 ESPN platforms where you can watch a game every night of the week if you want to. They also have a gambling app, and I'm willing to bet you guys are going to watch ESPN this weekend.
Coming out of 2021, Disney had been beaten down, both due to COVID and bad management. Ultimately, the former CEO, Bob Iger, was able to step back into his CEO spot. And upon this, he made it clear how much he loves Disney and everything he was willing to do to turn the company around.
Hi, Max. We talked about the past, but what about today? Theme park attendance is up 7% with the new Fast Line Pass coming up, so Doc gets to skip the lines. On top of that, cruise lines are also up 3% with 3 new ships to set sail next year.
With our buying date just being a little bit before their Q3 earnings, we've been able to realize an HPY of 21.69% in just under a month.
Contrary to what you might believe, we don't own any crystal balls in the cafe. However, through conducting thorough analysis on a company, we can forecast how they will perform on earnings. I mean, just look in the top left corner. 80% of the companies that we elected to hold through earnings actually beat on earnings. And that's compared to the S&P's 71% beat rate.
In the example on screen here, what you're looking at is one of our healthcare holdings, Viatris, and their price movements leading up to their earnings date. Due to the necessity and dependency Viatris's products have, they are able to generate these steady revenues that stay consistent throughout the years. Some of these top products for the company include Zoloft, Xanax, Viagra, and most importantly, EpiPens. I mean, think about it. Some of these products are things that people just cannot live without.
Now, we bought Viatris on October 7th of this year, and we had bullish expectations. Given that Dawn mentioned the product necessity, we've seen food allergies increasing as well as therapies for rare diseases. Now, Viatris hit on earnings, both EPS and revenue by a country mile, coupled by increased guidance going into next year. This allowed them to see a 13.52 price increase. Investors finally started to realize how good of a company Viatris is, something that we realized a month ago.
Now, as Q had mentioned within our growth funds, expectations don't always align with the reality. We're going to show you an example of one of the investments we made this semester, which is a company I'm sure you're all very familiar with, Target.
Offering both Starbucks and Ulta, Target enhances the shopping experience, which we all know and love. Walmart, their biggest competitor, had just announced their Q3 earnings, which was a beat, and they raised guidance just the day prior.
In addition to this, we identified what we believe to be a price floor, as can be seen by the green line on screen. In addition to that, we calculated with our own numbers that Target was approximately 53% undervalued. To us, this represented an opportune buy-in point.
For their next earnings report, as you know, the holiday season is coming up. I'm sure many of you guys will be doing a lot of that shopping at Target. But what actually ended up happening in reality was that Target ended up missing on EPS by 19%, and it had a 21% price drop. I mean, you can take a look at their earnings history right here. You can see a strong trend of beating on their earnings and increasing their guidance, giving us all the more reason to be bullish on the company. And if you were to tell me that just the day before their earnings report, their direct competitor, Walmart, would not only hit on EPS, revenue, see a positive price reaction, and raise guidance for 2025, that Target would then react to this with losing 20% of their value in just one day, I think I'd call you crazy.
Despite promising guidance in the previous quarter, Target managed to miss absolutely everything in a dramatic fashion. This poor guidance can be attributed to the future concerns with tariffs, which are expected to hurt Target significantly worse than their competitor Walmart.
As we've explained to you guys, this did not work out the way we wanted to, and because of this, Target was no longer the stable value holding we once thought they were before their earnings, and we were forced to get out of the position.
Now let's get into what you all want to see, our performance metrics for the year. As you'll notice, value is underperforming the S&P on a raw return basis, but this is expected as we require lower volatility for our companies in value. But this is reflected in our lower risk measure, or beta, of 0.6.
So with using a lower beta, again, we were able to see variations in our Sharp and Trainer. With our Sharp being just in line with the market at 2.01%, meanwhile our Trainer significantly outperformed the market at 27.79%.
And this all leads us again back to our risk-adjusted return, or alpha, beating the market by a whopping 2.21% this year, showing that our value fund did successfully mitigate risk and we chose the right sectors for our holdings. Now, we've all learned so much this semester in both market knowledge, technical skills, and soft skills that we're going to bring into industry with us. One thing that I wanted to highlight was learning about investor psychology and how it affects the market, where we took a whole day and lecture to learn about game theory.
As a group, we learned that the market is in fact a random walk. No matter how much work you put in, how much thorough analysis you perform, the market will not always perform the way in which you had hoped.
This group also learned the importance of the contrarian opinion. When investing, it's important not to become sheep, and this contrarian opinion can prevent us from getting caught in the herd.
In working so much in groups, I learned that it's important to know your strengths and weaknesses. You wouldn't pair an analyst like me, who's qualitative, with an analyst like Max, who's quantitative. This allows for that group synergy, and it allows us to create that more well-rounded work.
One of the first things I learned was the importance of attention to detail. Offering uniformity and precision are key to professionalism, and it's something that we'll all be able to take into our future careers.
One thing I learned early in the cafe is the importance of digging deeper, especially in the overvalued market that we've outlined. Some fundamental metrics didn't paint the full picture. That's when Doc taught us that it's time to grab our shovels and dig deeper into cash flow statement analysis to find trends for ourselves and determine our own fundamental analysis of a company.
As someone who had the opportunity to do the cafe for multiple semesters and over the summer, one thing I learned is that you always need to be able to adapt to the new environments you're putting in. Although I knew some of these people through classes and had that, throughout the semester I was able to become very good friends with them. And this can be seen on screen as we have been spending plenty of time outside of class together, which has really highlighted the importance of a strong work environment, which has not only led to better work, but has also made us closer as a group overall.
And at this time, I would like to welcome to the stage Avery and John, two of our cafe advisory members.
I think we should give them a round of applause for. Fantastic job, guys. You have a lot to be proud of. And I also appreciated the humor you guys brought to the presentation. It seemed like a fun group.
That was good, yeah.
As cafe alumni and now someone who has the honor of sitting on the board of directors, I want to thank all of you for being here today. Parents, students, faculty, and alumni, your support allows the cafe program to thrive. And to those alumni who also financially support the cafe, thank you.
Yeah, it's contributions like these that enhance all aspects of the cafe portfolio management program. And with every future generation continuing to give back and learning from these examples of paying it forward, it just keeps going.
So thank you guys. And again, awesome job to the analysts.
That concludes our final presentation. We want to thank you all again for being here. It means a lot to us. And now we'd like to open it up to any questions from the audience.
Could you speak to adding a new name to the portfolio? How do you pressure test that new name coming in? Kind of what's the process?
Yeah, so I would say when looking to add different companies to our portfolio, obviously we're looking at competitors in addition to financial statements and all those metrics we had mentioned. So with looking at competitors, we're kind of able to see how these companies differentiate themselves and are exposed to different risks. For example, with Union Pacific, we look for a company completely away from the East Coast, whereas we wouldn't be subject to any of the port strikes there relative to other different railroad networks which do have stations on the East Coast.
So do you bring that name to your peers and they pressure test and say, well, did you think about X or Y? Help me with the rigor in adding a new name to the portfolio and potentially taking something out.
Yeah, definitely. I'd say the big thing is that we all play devil's advocate at times
Good.
with each other, kind of keeping each other in line, because we'll have with the way that we are, we're in 3 groups of 3. So you have 2 people with one opinion, and the other will completely hate the idea. So just come and figuring that out and showing that being the devil's advocate there helps out.
We also mentioned the fact that we're one big family, and just like a family, we do fight sometimes. And so when we're all around that table pitching a company, we know it's not personal. We all just want the fund to perform well. So we really expect everybody to bring their concerns to the table. And if you have a company you believe in, you got to fight for it to get it into the fund.
And it also relates back to the emotional investing that we were talking about, specifically selling a company. As someone who's put a company into the fund, it's a lot harder of a pill to swallow when someone wants to sell it, even if they're coming with good points. So that's just a part of controlling our emotions and, making sure that we're making the right decisions.
Thank you.
What can you guys tell me about Target Resources? I see it has a 100% holding period yield, and that's really impressive. So what did you guys see?
Yeah, absolutely. So this company is within the oil and gas midstream industry, which we deem to be one of the safest companies within this industry. And as Sam had mentioned earlier, they were also a mid-cap company when we chose to invest in them. So what this did is it allowed for high opportunities for growth. And with that, we target this industry a lot because, as as Zach had mentioned earlier on, there was a lot of volatility within the energy sector itself. So by kind of hedging that against that volatility and being able to get into a safe industry like this, they have done exactly what they wanted to for the time period that we've held them.
Thank you.
With you guys having maybe like a pessimistic view early next year, what would be your exit plan for a company like that? With it being up like over 100% APY, would you want to continue to hold? Or?
Yeah, well, we would have to reevaluate is what we would do. And then as someone had mentioned earlier on, we do have a buy and sell list of companies ready. So if we decided that this was a company we'd like to move on to due to the situations you've mentioned, then we would do another analysis and, come right ready with another company.
Yeah, I think first we look at fundamentals, then we look at behaviorals, and then we look at, just any other factors that could be impacting this, like such as technicals. So if any of those things aren't lining up with, why we like the company, then like Dom said, we do have a buy list ready to go, so we'll have something ready.
That's part of the fund, just being actively managed. We can make moves like that whenever we feel right, whenever we feel is right.
Yeah, great job, guys. I'm sure geopolitics was an overarching issue across your semester. So I'm curious how you guys kind of navigated that and if that influenced your security selection at all.
Well, I like to think we kept a neutral position going into the election. There's a lot of uncertainty, obviously. We know polls aren't accurate. We didn't want to make any assumptions based on our own beliefs, so we'd rather just stay neutral. And then again, we are actively managed, as we always say. So in the case that we see different sectors, different companies benefit during a different election, we'll then change our approach and find companies that suit those benefits.
Yeah, and talking about the conflicts in the rest of the world, we took an in-depth dive into these countries and what specifically they're exporting and tried to stay away from those goods, as there's now war volatility, there's war premiums, and there's a lot of things that could be happening that could affect our funds.
I had a question which is away from what your analysis is, but more about the experience. And we just heard it's so important to pay forward. So after the experience that you've had in CAFE, what would you tell future CAFE students to do differently or to follow what you guys have done? What would be this one piece of advice that each of you would give to future CAFE students to carry with them?
I would say my biggest piece of advice is be willing to learn. In the cafe, we have access to so many resources like Bloomberg and Quote and things that other people at our group, like at our age and competition and other firms, don't get to have access to. So with it, we spend all of our time pretty much in between classes, in our free time in the cafe, whether it's playing on Bloomberg and kind of learning and getting to see what's going on in the world and things along those lines.
Another thing I'd say, Doc really wants us to truly be ourselves when we're in the cafe, and that goes for everything in life. Being yourself, you're not going to become a sheep. I don't want the new people coming into the cafe just automatically agreeing with everyone, because as we know, the contrarian can be right, and that's key.
I think it's also really important to not expect to know everything right away, and no matter how far along you are in the semester, there's always things that you're not going to know. And I also think it's important to always understand that there's always someone out there who can teach you something. So just keeping an open mind is really important.
Yeah, building off what Sam said, we learn from each other all the time, just as much as we learn from Doc. When we're in that room, it's just questions flying left and right, because if you just throw it out there, we have an amazing group of people up here, and we always have somebody who can help you out.
as young professionals in a growing technology field, how does AI come in to either any of your analysis, and what do you see it? What place do you see it in the future?
Well, we strictly stay away from ChatGPT. Like Jimmy was saying, we want to be ourselves. We want to have our own opinions. We don't want, something writing our articles for us. Even just reading as many Bloomberg articles as we have this year, it's easy to tell which ones are ChatGPT'd and which ones aren't, because they don't have that opinion or that personal effect that we're looking for. Going into the future, I could say it's a good assistant. Maybe it will make some people more productive, but I don't think it will replace jobs. I don't think it will replace that intuition that the analyst has.
As for capitalizing off of AI from an investing standpoint, I think, looking at how they power AI and looking how they cool AI is really important. So, like Jimmy was talking about, Amazon, Meta, they're building these nuclear facilities on an island. Microsoft, nuclear facilities on an island. So, looking into these companies is really important because, they're trying to fuel AI. They want to be first.
Additionally, with that, as Max had mentioned earlier, there are scenarios where companies may be using AI as something like a buzzword just to gain that attraction from investors. So what we have to do is see what the revenues that may be coming back are from these companies to ensure that this AI can actually prove to be successful with their company, and they're not just saying that to try and prop their price.
I would say an example of that too is Dick's Sporting Goods. I know in one of their most recent earnings calls, they had mentioned artificial intelligence, and whenever you think of a company like Dick's, they sell goods, they sell sporting goods. So there's not really an industry where artificial intelligence is going to play like a massive role in helping a company like that. So we kind of saw through that as it was more just a buzzword to help drive the company.
Great presentation, guys. You can see all of your time and dedication really shine through in your final presentation. What trade or what pick are you guys most proud of with a semester filled with so much hard work?
Absolutely. I mean, one of the ones we took you through within the presentation was Primora's services, and basically what we explained to you guys was that they were highly correlated to the utility sector, and given that this sector was running the market, this was a great decision for us, and we have yielded almost 40% on the company with only holding them for 2 months. So this is definitely one we can say we're most proud of.
I would say from a consumer discretionary standpoint, we're really proud of the Finding Burlington. I know that for a fact. When I told Doc first that I was going to pitch in Burlington, he kind of chuckled because I'm sure you're all thinking like Burlington Coat Factory. But when we looked into it and we found that how they've rebranded since 2013, their organic growth methods to increase stores, especially within that industry, getting in front of people, opening store locations is the biggest thing. They opened 79 stores this year, projected to open 121 stores next year, and that's allowed them to beat out competitors like TJ Maxx and Ross. So they've completely rebranded. And I think that we could see through the management team that was super effective. And so we were able to get in on Burlington ahead of the curve. And now, after the last earnings report, they ran over 15%. And additionally, they have all their price targets coming in above $350 a share, which is pretty incredible.
Yeah, one really cool thing specific to Burlington as well is that this year we've seen decreased consumer confidence, and that kind of made Burlington stand up because they do sell name brands that maybe some people aren't willing to go to Nike and buy. Like you can go to Burlington and buy Timberlands, Nike, whatever. So that also played a factor.
Thank you for your presentation. It was excellent. How do you go about making a decision to buy or sell shares? How do you reconcile your different views about a company?
Well, to buy a specific company, we pitch it to each other, but I think you're talking more about our weighting scheme and how we choose which weights to put in which sectors. And we do that, we all sit around the table, and we all have our own sectors, as you heard at the intro. Each analyst is assigned their own sectors, and they're in charge of monitoring them, monitoring how economic news is going to impact them, how global news is going to impact them. And then once a week we bring these ideas to the table and we talk about, okay, something's happening over in the Middle East that's going to affect energy. We want to get out of this sector and move it more into something like financials with the rate cuts coming up that's going to give them a boost.
I think especially too, just with our weighting scheme, and we have our sectors obviously, so we have a really in-depth understanding of what's influencing revenue streams throughout the sectors, and that provides us an opportunity. Like, say our technology analysts see a really big driver for a certain section of tech going forward, they could come to the table meeting and say, hey guys, we want to add weight to tech, and here's why.
Everyone, if you don't mind me interrupting real quick, what I'm most proud about this group is, and I think you can touch upon it as well,
the things that we learn most of all is that we don't garner alpha through choosing stocks. We garner and beat the market. We garner alpha and beat the market through the weighting schemes and the most intense. Johnny, speak to the first 2 weeks of trying to truly figure out what is happening. And that's what leads these student fund managers to make educated decisions about the weightings within our fund. That's amazing, but it's a lot of work. Speak to it.
I mean, especially this semester, we've had a lot going on, as we pointed out. So these weighting scheme constructions changed at sometimes like a weekly basis. We would be looking at the economy and the market and saying what's going on, what's going to drive our fund, and then reallocate our positions and try to come up with the best approach. Obviously, there's a big disparity between our year-end outlook and our 2025 outlook, and I think that's a perfect example of what Doc's talking about.
Yeah, to get more into that, the first month or so, we had an outlook that the market wasn't going to produce the way it is, and obviously it's hitting 6,000 right now. So about 4 or 5 weeks, we had to switch that, change our weightings, put it in more companies that have a higher risk return, and we did.
And so to kind of put that into like actual timeline for you, we had a week where the port strikes were going on, in addition to crazy Middle Eastern tensions, in addition to a hurricane and a presidential election all at the same time. So it really made us be dynamic in our weights and being willing to adjust on the fly.
Needless to say,
Chef, did you sleep that week?
I was going to say, needless to say, we didn't sleep much that week.
I was just going to add on, I noticed it said sleep was for the week, and I saw on your Instagram last night that you were practicing at midnight and have heard the numbers of hours. When you think about if this is a career that you want, to pursue just for your own, personal well-being, what have you learned about needing to bring your best self to this while also balancing your other academic rigors, your college life, the athletics? Any strategies or tips that you found that worked for you that you could bring forward with you as you pursue careers?
I think being well-rounded is really important. Find hobbies, find other stuff you're passionate about, like going to the gym, being on a sports team. Like that really helps me at least. I'm sure others here.
And one thing I want to give this group some credit. We all love what we do, and we're all very passionate, and that makes it a lot easier to be in the cafe at 2, 3 in the morning when you do love what you do. And that's what we see with people that aren't able to keep up with this standard. It's really because they don't love the work.
Yeah, and I know it makes no sense, but you do get addicted. Like on weird days where it's like 6 p.m. and we're not supposed to be in there, I'll literally call Max and be like, am I doing something wrong? Like, what's going on? And then it's crazy. Yeah.
Who did the most 4 a.m. reports?
I actually, given that we have 9 analysts and we have 5 pre-market reports, 2 of people, I actually had to do mine Sunday into Monday by myself this year. So that was a fun little time.
We all low-Q, a lot.
Sunday was never canceled.
Yeah, Sunday would never get canceled.
Everyone else week.
It's okay. I can
Seeing
tell you
how-
at the least.
I was gonna say, seeing how busy you guys were, I'm sure you guys had a lot of all-nighters. Is there a most memorable one?
There's something that's memorable about just about every one of them. One I'd like to highlight is it was actually Halloween night. We stayed in there because this was during our value reconstruction week, so we had a lot of work to get done. So we ended up staying in there, looking at every company and then pitching them to each other. And we had goofballs like Max and Johnny dressed in their Disney ears the whole night. So.
we were pitching Disney that week, so we really wanted to push Disney.
I hope we did well.
Doc always talks about these vision quests, and it's funny. Like we hear him say that all the time. And then during the semester, we'd be sitting there at 3 a.m. and then we have this epiphany. And I wish we had a recording that we could play for you guys of some of the conversations we would have at 3 a.m. around that table. It's pretty crazy the things that we would come up with and the realizations that we would have. And honestly, they were huge for us this semester in terms of our performance as well.
Well, thank you, everyone. I greatly appreciate this. And Dean, would you like to close out for us?
I mean, it's a very hard act to follow, right? But because this is the best of us, is our students and the work that they do and their dedication, their learning. I just want to give a big shout out to Professor Melton. So if he can give a big round of applause to him. When the students are doing the 3 a.m.
years. They're often texting him in the middle of the night, and so he has spent sleepless nights with them with all of this. And it's a labor of love for him and for everyone. And I also want to thank all our alums for coming back, because it's this continuity. This is a huge program to continue into 20 years. This is the 20th year of this program. Many schools have adopted similar programs since, but to actually keep it going year over year, sustaining an endeavor like this takes a lot. And it takes leadership, of course, with Doc. It takes the passion of the students who are in the group and their hard work, and everybody going on the journey, right? Like, each of them have to, you have to go with the flow. You have to buy in to the fact that this is the hard work that's going to pay off. And I think they all do it year over year, our students, and then the testament of their success in what they become in their careers, and coming back to give back to the same students, to the same program, is what is the is the secret sauce. And so there is not much that I can say except thank you to all of you for coming out on this really cold but beautiful Saturday to listen to these amazing presentations. And I wish you guys a wonderful winter break and holiday season.